Well, good evening. We're going to spend some time this evening going back through the material that we covered on Monday night in the second class. Unfortunately, the video didn't render. There was a problem in the file and it became corrupted, and so I'm having to re-record these. And that means that we'll have the discussion, but without the benefit of questions and answers from you. And I'll try to replicate as much as I can some of the information I shared as a result of the questions that you may have asked, but we won't have those exact questions, and I apologize if I end up leaving anything out. We'll do this in 3 segments tonight. We'll first take a look at the class schedule, a little bit about where we're going. We'll take a look at Canvas together, and then we'll work into the first elements of the discussion, which will be looking at opportunity cost and economic profit, looking at just some brief review of a few of the items that we dealt with before that lead to economic profit and opportunity cost. We'll look at the market value of debt in another segment, and the market value of the capital components. And then we'll look at the composition of weighted average cost of capital. So let's go ahead and begin. I'm going to share the screen so you can see the syllabus and just help you understand about the next couple of weeks. So we're looking now at this week, week 2. And you can see, just as I said, the items we're going to talk about. I don't know that we'll get to the point where we discuss the Gordon growth model tonight. We didn't do it when we were together on Monday night, so my guess is I'll leave that off today as well. We'll pick that up as part of the discussion of time value of money metrics this coming Monday evening for week 3. When we talk about economic profit and opportunity cost, we'll define economic profit, but we'll also talk about the value condition of ROIC, or return on invested capital, versus weighted average cost of capital versus growth. And I'll try to help you understand that conceptually before we go into the details of how we calculate weighted average cost of capital. We'll then go into quite a lot of detail in the cost of capital equation, which means that we first have to identify the value of the firm's capital components. So we'll do this again, as I said, in 3 different segments. Before we move on from the syllabus, though, I want to talk to you a little bit about next week. So for Monday night, we'll go through time value of money metrics, and we'll walk through those basic metrics all the way through present value, net present value, internal rate of return, etc. We'll look at a multi-columnar valuation structure, and we'll begin to talk about valuation equational forms, explicit periods, continuation periods, and we'll go a little bit deeper into using some of the Excel templates and building models in Excel. You've already begun to do some of this, so I don't think it'll be foreign to you. So let's look at Canvas for a moment with respect to this. You'll see here that I've already loaded in Canvas the PowerPoint that I've used for this discussion this evening. One of you asked on Monday night if I'd be willing to load those in advance and send them to you in advance of the discussions. I'll try to do that. There's no reason I shouldn't be able to, and that way maybe you'll choose to print those out, follow along and such, and if you don't need them, fine, but they are the material I'm using. You'll see that in these 3 items that I'm highlighting here are the 3 different segments of the class that I'm doing tonight, as I will post the videos to Canvas. And then there's also a separate video on the market value of bonds that I created some time ago that might be helpful, and it may be a nice complement for you to what we're working on here. There's another YouTube video that I picked up that's just the market value of debt that someone else has recorded. Maybe it'll approach the item in a different perspective, when there might be a little bit more one that you might be able to grasp a little bit more readily. Some people do. Most people are good with my videos on this. And then we'll look at some of the other items. Here we've got capital asset pricing model and WACC, ROIC and growth, cost of capital, and then an introduction to the 2 homework assignments that are coming from week 2. I know that most of you are already deeply into these, and some of you have already even submitted these. As we prepare for week 3, notice that I have not only the time value of money quick sheet, but I have videos for you, 1 through 9, that help you understand how to do the equations, the calculator processes, and a little bit of Excel on various time value of money metrics. Everything from a very simplistic present value all the way through a net present value and internal rate of return. It will help you immensely if you will review these videos prior to our class on Monday night. In fact, it'll cut a good hour off of the class. And if you'll do that, it'll help you, it'll help me, you'll get a lot more out of this. If you don't do it, some of you are simply going to be lost. And then you'll have to review them afterwards, and you'll wish you had done so in advance. I'll be sending out something imploring you to review these prior to the class via WhatsApp, but I wanted to make that request now as well. So you'll remember that for each week, I introduce the topic, and I have some meaningful level of resources here for you in support of that week's concepts. And again, take advantage of these. It'll help you immensely. So let's go ahead then and take a look at the PowerPoint I put together for tonight, and start by looking at these initial concepts, these fundamental principles, if you will, that I'm going to go ahead and revisit. Again, those will be in invested capital, return on invested capital, and growth. Then we'll look at economic profit and opportunity cost. And then we'll go into another segment where we look at the market value of debt, which means we're going to look at the market value of the firm's capital components. And then the last segment will be as we are looking at the weighted average cost of capital. So let's start with invested capital, ROIC, and growth. So you'll see that invested capital, I'm giving you the two equations here. One is the operations approach equation of fixed assets plus net working capital. We walked through these last week. The next is the financing approach, which is total equity plus total long-term debt. And those two equations should give you the exact same outcome. I believe I told you that I typically use the operations approach to networking, or excuse me, the operations approach to invested capital. The question is, why do I do that? It's fairly easy when you conceptualize these. First, let's talk about the second approach, or the financing approach. If we look at the financing approach, we're looking at the entirety of the company. We're looking at the total equity that the company has developed, whether that's from paid-in capital or additional retained earnings, and we're looking at the total long-term debt. Well, when that equity was developed, when it was raised, or when it was earned through additional retained earnings, that equity then was used in various parts of the company. And there's no easy way to identify what part of the company, what dollar of equity was used in support of. Maybe we had an equity round that we raised 10 years ago, and that brought in $10 million to our company perhaps. And when we did so, we capitalized various aspects of the company, and now the company has turned into this multinational behemoth. And I'm hard put to tell you which dollar of capital that was raised 10 years ago is embodied in our France operations versus which part's embodied in our Texas operations versus which part's embodied in our Bogota, Colombia operations. So if I want to think about only a part of the company, I can't do so with using the financing approach. The same thing could be said of long-term debt. I raised $10 million of long-term debt. I use that debt in support of various capital assets and various operations. And it's virtually impossible for us years after the fact to separate out what part of the debt was for Dallas, what part was for Bogota, etc. However, if we want to look at only part of the company, identify a value for only part of the company, and this has to do with less about valuation than it does about executive decision making, as we might localize the valuation discussion, then I need to understand what assets are embodied in any given part of the company. So it's probably fairly simple for me to understand what fixed assets are being used in support of the operation in Dallas. Well, they're the fixed assets that are in Dallas. What the net working capital items, whether it's inventory or accounts receivable or even cash, result from the Dallas operations. Similarly, I can parse out the France operation by looking at the fixed assets and net working capital that are embodied in the French operation. I can't do this when I'm looking at the financing approach, but I can easily parse out separate elements, operational and non-operational elements of the company when I'm looking at the operations approach. So I always defer to the operations approach. It allows me to look at the entire company if I might like to, and I'll come up with the exact same value for invested capital, looking at the whole company through the operations approach that I will through the financing approach. But if I'm only going to be using part of the company's operating assets and net working capital, maybe even some of the non-operating assets, I can look at those in segments rather than have to look at the entire company all at once. So I routinely use invested capital under the operations approach, and I would suggest that you do so as well. Well, let's move to return on invested capital. So return on invested capital is simply our NOPLAT, or net operating profit less adjusted taxes, divided by invested capital. It gives us a return, no different than return on equity or internal growth rate or return on assets gave us a return. This is a ratio, it's a percentage. Well, in this case, it's a percentage representing our net operating profits less adjusted taxes as a percentage of our invested capital. And that's helpful for us, whether it's for the entirety of the company or whether it's simply for part of the company. Because if I can parse out the company's assets, fixed assets and net working capital based upon an operation, I can probably also parse out the company's revenues and expenses in support of that operation. I can identify the tax rate in support of that operation, and now I know NOPLAT in support of that part of the company or the whole operation, whole company, whichever I'm wanting to focus on at that moment in time. So return on invested capital. Well, growth we talked about a little bit last time as well. And we made the argument that when we look at the company's growth rate, we look at it for a near term or an explicit or discrete period of time, but we also look at it for the long term. And we argued that when we're looking at it for the long term, we're looking at a relatively low level of growth, something that is reflective of commodification within our economy. So we're looking at 2%, 3%, maybe 3% growth. But we're not looking at 6 or 7% long-term, because long-term is perpetuity. It's not only 10 or 20 or 30 years, it is forever. And anytime you try to apply a number more than 3 or 5%, anytime you try to apply a double-digit number to a perpetual growth rate, very quickly the value of that which you're applying this to becomes greater than the rest of the economy. When I say quickly, I'm talking about some decades, but that's quick compared to millennia. So we're going to have to think about growth for a few minutes, and we'll challenge whether or not it's realistic to have growth rate be in the 10 to 12 or 13% in the near term, and then have it ratchet all the way down to 2.5% in the long term. So let's do that for a moment. Let's suppose for a minute that there's 3 people in the company that are vying for the CEO role. And we're going to be choosing a CEO based upon their ability and willingness to deliver to us strong growth, because we're the stakeholders, we're the shareholders. Well, that's going to be the CEO who we think has the operational wherewithal to give us more than 2 or 3%. They're going to give us 6%, 7%, 10%, 12%. They're going to do this in part, of course, because of the market that they find themselves in, but they're going to do it because they have managerial prowess. They have some expertise that they're bringing to bear that will make it easier for our company to reach those production levels. Well, if that's the case, then why wouldn't we argue that we would always have a CEO that would do that for us? So let's assume that George is our CEO and George is retiring, and George has been replaced by Shelby. And Shelby has great promise. Shelby likewise will maintain our history of good growth. She's agreed to see to it that the dynamics and the innovation of the management team are maintained so that we maintain this heritage. And because of that, Shelby's going to be paid, like George, a multiple 6-figure income, probably receive some nice stock options and bonuses and other corporate perks that make it very appealing for her to maintain the job and very rewarding to maintain the job. But now, 5 or 6 years have gone by, and Jonathan has applied for the role of CEO, and Jonathan has received the job. Jonathan has promised and has a track record suggesting that he'll give us the same kind of growth as much as possible based upon the prevailing market currents, give us the same kind of growth that Shelby gave us, which was a continuation of the same kind of dynamic growth that George gave us. And this will be another 6%, 7%, 12% based upon the prevailing market. And we could argue that this same kind of routine would carry on, that after George and then Shelby and then Jonathan, we might have Diane. And we'll continue to go on with this heritage of great CEOs that are giving us this double-digit growth. But is it realistic to believe that we'll always have those? Or is it more realistic to think that we can project out for a relatively short period of years some strong growth, but we recognize you can't continue to project it out in perpetuity, and so fairly quickly we have to then normalize the company's growth into the long term. And in the long term, companies grow basically at the rate of inflation or the rate of GDP. So we're going to have to think about this issue of having an explicit or a discrete period growth rate that we would argue, and we could give lots of scenarios where it would support that that should be very robust growth. It's going to be about our innovation, our ability to attract merger and acquisition transactions, about our managerial prowess and the expertise we hold in the market, our leadership premium in the market because we are just that good in this company. And we could try to argue that and argue that decade after decade after decade, we should be able to accomplish that in the company. But the fact of the matter is, it's just not realistic. And so after a relatively short period of time, we're going to have to assign ourselves to a relatively mundane, commodified growth rate. And I'll suggest that that should be 2, 2.5, maybe 3%. I'm on safe ground here for a couple of reasons. One is that you cannot point to me any publicly held company that's maintained double-digit growth for 3 or 4 decades or more. You simply can't. It's a stretch to find one that we would even purport to have maintained double-digit growth for 2 decades or more. Well enough 3 or 4, well enough millennia, because we're going to be looking at perpetual equational structures, and those go on for more than just a couple of years. Long-term in the routines that we're going to be looking at, long-term is not 10 years, it's not 20 or 50 years. Long-term is millennia, it's forever, it's perpetuity. And we'll discuss more about why that is when we get to looking at those equations. But just recognize we're going to parse out explicit or discrete time to be relatively short-term. By that I mean 3, 5, 7, maybe years, and then long run, and long run will be perpetual. So with that, let's look a little bit further at some numbers. I'm looking now at numbers with invested capital, ROIC, and growth rates that are reflected in the Mirage-Ravana case. And you have that spreadsheet. I'll flip back and forth to it a couple of times during our discussion tonight. But here, if we're looking at Mirage-Ravana, we see that we pick up invested capital through the operations approach of fixed assets plus net working capital. So here we have fixed assets. Net working capital will be current assets minus current liabilities. Let me make a note here about fixed assets on the balance sheet with respect to the operations approach of invested capital. This company only has fixed assets that might be considered as operating assets. They've not been differentiated out as operating and non-operating. But we might have a scenario in which the company has some fixed assets that are identified as operating assets and some fixed assets that are identified as non-operating assets. Well, if we're analyzing or assessing a value or looking at the entirety of the company, we're going to use both the non-operating assets and the operating assets. If the case that you're looking at specifies we're only looking at the operational part of the company, then we might only look at the operating assets. So know that just because we're using the operations approach, we may not only look at the operating assets. We might be able to parse this out in any way that we've chosen. We dissect it out in any way we've chosen. Well, in this case, if I take the fixed assets plus the net working capital, I can see that I end up with a invested capital of 130.668. And my guess is most of you have already identified that as you're going through your assignments for this week. Similarly, if I use the financing approach, I'm going to come up with the same number, and I get that by taking a look at the owner's equity plus the total long-term debt. So let me show you the spreadsheet here. So owner's equity, which is the paid-in capital for the common stock, for the preferred stock, so the original amount of monies that were given to the company when they sold common and preferred stock to the investing public, and then any accumulated retained earnings or excess profits that they've reinvested in the company in the interim. That is owner's equity. Total long-term debt in this case, is the book value of total long-term debt. Now, you already know that I don't love using book values. But when we're looking at invested capital and we're looking at return on invested capital, we will use book values because it's the book value that reflects what was invested in the company. Oh, it may have a greater value today. It may have risen to some market value, but when the money was invested in the company, it was invested at a book value. So the common stock came in at 5.57 over the periods of fundraising, but it may be worth many multiples of that today. In fact, hopefully it's worth many multiples of that today, as company managers have effectively invested that and invested additional paid-in capital. So don't get lulled into thinking that book values have no bearing in invested capital. We tend to use book values in invested capital, and we use them rarely in other aspects of the course. Well, if we think about return on invested capital, we note that our company had 22.987 in NOPLAT, or net operating profit less adjusted taxes. We can see that the company had EBIT of 31.063. We interact that with a tax rate of 26%. So we take that EBIT times 1 minus the tax rate, so 1 minus 0.26. That's the same as taking the EBIT times 0.74, and it's going to give us our return on invested capital, or it's going to give us our NOPLAT rather, of 22.987. So EBIT times 1 minus the tax rate, or 31.063, times 0.74 will equal 22.987. And you can see exactly how I've done it. I've picked up the EBIT here rather than here, but it's the same EBIT. And it's given me the NOPLAT of 22.987. I then divide that by invested capital, however I've calculated it, and I end up at 17.59%. That's pretty straightforward, and I think you probably get that without too much other additional discussion. I already had a very brief discussion for you on the growth rate. Let's now talk briefly about this relationship that I represent here of ROIC, WACC, and G. If you've taken the opportunity to review much of the Demoterin information I posted online for you, or if you've taken the opportunity to review much of the valuation cornerstone of value material I posted for you from McKinsey, you'll recognize or remember that there's a valuation relationship that's important. So think about this for a moment. The entire value relationship is a function of the relationship between return on capital and cost of capital. And we'll look at return on capital as ROIC, return on invested capital. We'll think of cost of capital as weighted average cost of capital. And we'll go through that equation here a little bit later in our discussion today. But think about growth for a moment. We all tend to think that growth is good for a company. And I'm going to tell you that growth kills some companies. Well, under what condition is that true? Well, it's true when the return on capital is less than the cost of capital. Think about that. If the returns we get from our capital are less than the capital costs us, then as we grow, we die even faster. We are cannibalizing ourselves. So the stylized fact here is that growth creates value when the return on capital is greater than the cost of capital. So think about that. If my return on capital was 10% and my cost of capital was 8%, so I've got a positive 2% spread there. As my company gets bigger, I'm getting a larger dollar amount of value because that 2% spread is being applied to an even larger set of invested capital. So as invested capital grows, then and we have a positive spread between return on capital and cost of capital, then the dollar value of that spread becomes greater. And we recognize that value is created there. If, however, the cost of capital is greater than the return on capital and the company grows, then we are cannibalizing ourselves. The negative value, let's say we had a cost of capital, again, of 8%, but what if our return on capital was only 6%? Well, we have a negative 2% spread. And as the company grows, so as invested capital gets larger, then that negative 2% is applied to an even bigger number, and the negative becomes larger and larger. We are depleting or destroying capital. So when return on capital is greater than cost of capital, or when ROIC is greater than WACC, growth creates value. When ROIC is less than WACC, growth destroys value. You've actually seen examples of this in the marketplace. You just may not have recognized it. Let me give you one that you'll get immediately. So you're driving down the street every day, you're on your way home, you're on your way to work, you're on your way to school, whatever it happens to be, and you drive by a business that you see over and over and over again. Maybe you've been inside that business, maybe you haven't. As it turns out, you don't know this, but that business owner is struggling, as so many small business owners do. And at night, they're just thinking, if only I could grow, if only I could find a way to get bigger and I can grow out of this struggle that we're currently having. So somehow, by their own sheer force of will, or by having found some other investment capital in the marketplace that they got to pay for, of course, they're able to grow. And they realize that it hastens their demise. And the next time you drive by, there's a closed sign there, or their sign has been taken down, or they're just not in business anymore. Well, I promise you that the majority of time when you see that, it's because the entrepreneur didn't realize that the cost of capital for them was greater than the return on capital. And they did everything they could to grow, and being resourceful entrepreneurs, they were able to grow, and it destroyed them. You see it all the time. You also hear about companies, big public companies, that have announced layoffs. Maybe they've shut 10% of their retail locations, or they've shut down a production facility, and all of a sudden you see the value in the stock market for that company to go up. That's almost counterintuitive. The company had to announce layoffs. The company got smaller. How is it that when they got smaller, their value became greater? Well, those companies that have right-sized, that's the politically correct term that we tend to use for that, those companies that have right-sized have almost certainly had a cost of capital that is greater than their return on capital. And when they right-sized, they got smaller, so they didn't grow, they shrank. And if growth destroys value when cost is greater than return, then shrinkage creates value when cost is greater than return. Think about that. If growth destroys value when cost is greater than return, then right-sizing, shrinking will create value when cost is greater than return. So if we want to create value for our stakeholders, if we want our firm to be worth more, we first have to identify, is its return on capital greater than or less than its cost of capital? If it's greater than its cost of capital, then growth will create value. However, if it's less than, if the return is less than the cost of capital, growth will destroy value. And right-sizing the company, as it turns out, may return it to a position where, once again, the return on capital is greater than the cost, from which point it can then start to grow with it having been in a better foundational situation. Okay, so let's continue on. Let's talk about opportunity cost. Well, I've got the story. The accountant walks into the businessman's office, the entrepreneur's office, and announces that their first year in business, which is just completed, they profited. They had a net income of $100,000. The accountant is ecstatic. And unfortunately, the entrepreneur puts his head down on the desk and starts to cry and uncontrolled. And the accountant just does not understand this, wants to know what's wrong. Well, what's wrong is that entrepreneur invested $2 million of their hard-earned capital, their life savings, maybe savings from other people in the business. And in that first year, like many entrepreneurs, they didn't receive a wage. Well, they earned a wage, they just weren't able to receive a wage. Because if we're working, if we're applying our skills, we are earning a wage. So we have to think about the economic profit of a company. The economic profit will be its net income minus its opportunity costs. And the opportunity costs are those opportunity costs of the investor's time and capital. So here, this investor, this manager, this entrepreneur previous to working with this firm, had worked with another firm, or rather previous to having their own firm, had worked with a firm that paid them $150,000 a year. And they know that the opportunity cost of their time, having been measured in the marketplace by having received these paychecks, is $150,000 a year. They also put in $2 million of their own money. And if they're not paying themselves a wage, they're certainly not giving themselves a dividend, and they're probably not giving themselves any interest on money that they could possibly have loaned to the company. So that $2 million has been invested in the company, and they're not getting immediately a return on that we can count with dollars and cents. But had they simply put that money into a treasury bill, into a CD at a bank, they could have gotten what, 1.5%, maybe 2%. So 1.5% on $2 million, I thought 1.5% on $2 million would be 30,000. So 15,000 per 100. So it would be $30,000. So there's an opportunity cost of the investor's $2 million of capital of $30,000. There's an opportunity cost of the investor's time of $100,000, or $150,000 in my example, excuse me. So a total opportunity cost of $180,000. So when the accountant said, congratulations, you have a profit of $100,000, and the entrepreneur sobs uncontrollably, is because the entrepreneur realized that as a financier and as an economist, they knew that they'd actually had a loss, an opportunity loss, but they'd had a loss nonetheless of $80,000. And that's why they were crying. So we're going to have to think about this concept of opportunity costs and with time and capital. And we'll primarily think about it with capital. As we talk about the weighted average cost of capital, we're going to put the firm's capital components into market terms. So we're going to try to identify the current market value of the capital components. And then we're going to have to look at the costs on or returns of those capital components. And you're going to see and hear me talk about cost and return as though it was the exact same thing. But let me make sure that we're all under agreement as to how I can do that. So here, Salman is my banker, and Salman loaned me $100,000. And the Bank of Syed, that's Salman's last name, Syed, the Bank of Syed charged me 6% interest on that loan. Well, what is my cost on that loan as the borrower? Well, absent any other processing or transaction costs or fees, my cost on that loan is 6%. What is Syed Bank's return on that loan? Well, again, absent any transaction costs, fees, etc., their return on that loan is 6%. So cost is the other side of the same coin on which we will find return. So you'll see and hear me use those terms interchangeably through the class. Cost of capital, return on capital. Cost of funds, return on funds. And we're going to see that over and over again within the WACC equation, the weighted average cost of capital equation, because you'll realize that the cost of capital variables will be referenced as R. R common stock, or RE as it turns out, R preferred stock, RP, R debt, RD, and R we think of as return. Well, if we were talking to economists, they would use the variable K rather than R. And they use the variable K because economists receive much of the language with which we speak from Karl Marx. Karl with a K, we use K instead of C when referring to cost when we think about economics. But cost and return are simply going to be two sides of the exact same coin. So when we look at the cost of these capital components, we're looking at the return, the expected return on these capital components, and we're looking at the exact same thing. And that's going to be part of the WACC equation.